can say it very clearly.
Okay, so cash flow statement generally is a is one of the components of the financial statement in accordance with the IFRS standard, that's International Financial Reporting Standard. So a cash flow statement is a compulsory requirement that is expected by every entity to prepare when an entity is preparing its financial statement at the end of its reporting period. So now, um, so basically, what does cash or what's the essence of preparing a cash flow statement? A cash flow statement is prepared, number one, to ascertain the overall profitability of an organization as at the end of its reporting period. To ascertain the overall profitability of an organization as at the end of its reporting period. Then the cash flow statement as well. We prepare a cash flow statement to determine the cash and cash equivalent at the end of the period. The cash and cash equivalent at the end of the period. Cash and cash equivalent at the end of the period. So we want to know how liquid are we as at the end of the period. We have prepared our income statement. We have determined how profitable we are as a result of preparation of the statement of profit or loss. But the fact still remains that the profit or loss statement does not really depict how profitable an organization tends to be in terms of profitability wise. The reason is because the profit or loss statement only shows, is prepared based on accrual concept. And as a result of accrual concept, there are some things that we recognize on the profit or loss statement that are non-cash items. They are non-cash items in the sense that they do not involve the movement of what? Cash. And if I'm going to have a small analysis, if you go to the market to buy something that worth 1,000 naira and you sell that thing for 1,500 naira, now you are going to say you have made a profit of how much? 500 naira. All right. Now, this profit of 500 naira that you have realized, you can see the profit in monetary terms, yes or no?
Yes.
Exactly. So that is when you say you have made a profit, that is how profit is. But here we are saying that the profit we are making, they are a combination of various items such as depreciation, various items such as amortization, various items such as provisions, various items such as gains, unrealized profits. Now, these items that has been incorporated together to be used in preparing the profit or loss statement, they are not going to show how truly a company is profitable in terms of its cash. Because when we are talking about profit simply means how much money can I see? So if my profit or loss statement is showing me 2 million, the question is, can I see the 2 million as a cash? If I cannot see the 2 million as a cash, so it means that I have not made a profit. So there is a statement, we're not saying that there is a statement that allows us to be able to determine the overall performance of the entity. It helps us to determine how liquid an organization tends to become. This is a statement called the statement of what? Cash flows. Now, the statement of cash flows provide information that helps the users to evaluate. It provides information that helps the users to evaluate changes in the net asset of an entity and its financial structure. It provides information that helps the users to evaluate changes in the net asset of an entity and its financial structure. It also provides information that helps users to assess the ability of the entity to affect the amount and timing of its cash flow in order to adapt to changing circumstances and unexpected opportunities. Now, the fourth one, which is the most important one, it helps users of account to compare the performance of different entities because unlike profits, now if you see that side, because unlike profits, comparison of cash flows are not affected by the different accounting policies used by the different entities. So, like what I said earlier on, the profit or loss statement is prepared on a basis of principles. So there are principles, there are policies, there are guidelines that are laid down in the preparation of the profit or loss statement. Now, these guidelines are laid down for us to be able to follow them. So, for us to be able to follow these guidelines, meaning that what we must not do anything contrary to these guidelines. But the cash flow statement does not have one policy it follows. It recognizes information based on cash, based on what? Cash. So that's why this aspect says, unlike profits, comparisons of cash flows are not affected by the different accounting policies used by the different entities. So entities uses different accounting policies to prepare their financial statement in terms of the profit or loss statement. But you don't make use of accounting policy to the when it comes to when it comes to cash flow statement. So generally, cash flow is used to what? Determine or compare the performance of an entity from period to period, from period to period.
It's a period.
Yeah. So if I want to know how well an entity is doing, if I want to know the state of solvency of that entity, I can know through the cash flow
Cash
statement.
flow
I can't predict how well an entity is doing through their profit or loss statement because profit is not real. Profit is not real. You get. So when we are
Yeah.
preparing the cash flow statement, in preparation of the cash flow statement, there are three activities that we must take into consideration. We have the operating activities, we have the investing activities, and we have the financing activities. We have the operating activities, we have the investing activities, and we have the financing activities. Now, in determining the cash flow from operating activities, there are two methods that we make use of. We have the direct method and we have the what? Indirect method. So the direct method and indirect method are two methods of determining the cash flow from operating what? Activities. While the cash flow from investing activities and cash flow from financing activities remains the same, whether you are approaching or you are working using the direct method approach or you are working using indirect method approach. So what are operating activities? Operating activities are generally activities that arises from the normal or the ordinary course of business. Activities that arises from the ordinary course of business, from the activities of the entity. So what are those activities of the entity? From the trading activities of the entity, from buying, from selling, from the revenue that the entity has generated, from the expenditure that the entity has incurred. So all those activities that arise as a result of the what day-to-day operation of the entity, they are the what operating activities. So that's why in the determination of a cash flow statement, especially when we are using the indirect method, we usually start from what profits before what tax. Profit before tax. So this profit
Yeah.
This profit before tax is a profit we want to adjust. Now, why do we start from profit before tax? We start from profit before tax because we want to adjust back that profit to give us the net effect, to give us the effect of
The
cash.
correct. Okay.
So we want to restate that profit back so that we can have the exact cash flow that has been used to carry out operation for the period. Because don't forget that profit is a combination of different elements. There is depreciation in profit, there's provision in profit, there's impairment in profit, there's amortization in profit. So all these information that are used in determination of profit, majority of these information are non-cash items. Now, the reason why these information are very relevant to the determination of profit is because, according to the accurate concept, entities must prepare the profit or loss statement in line with what operation for the reporting period. So, if I want to
Okay.
determine profit for 2018, it must be all my activities as of 2018 that must be reported in my profit or loss statement. So, and it means that if I have an asset that has been in existence or that I just acquired as of 2018, the rule is that I must calculate what depreciation. So,
Depreciation.
calculation of depreciation means that there is a portion of my assets that I am charging to my profit or loss statement as an expenses for the period. So, as a result of calculation of depreciation, I have incorporated a non-cash item in the determination of my profit. So whatever profit I am realizing for the period is no longer is not going to be a profit that depicts the true cash flow for the entity, because a lot of things makes up the what profit. Now, if I'm starting with my profit before tax, so the essence of
Yeah.
starting with profit before tax is that what I want to adjust back that profit before tax so I can have a profit that represents cash. Because this profit before tax is a profit, is not a profit that represents cash, it's just the normal operating profit of the business for the period. And remember that it is on my tax I'm going to what take away, sorry, it's from my profit I'm going to take away what tax. So because I'm going to take away tax from my profit, it is whatever profit I have realized that I will subject to tax. So that's why we are starting from profit before tax. So you see that after profit before tax, the next thing we do what? Add back, or sorry, adjust for what? Non-cash what
Cash.
items. So we now begin to adjust for non-cash items.
Yeah.
Depreciation, profit on loss of disposal, loss on disposal, impairment, amortization, any non-cash item, we adjust for them. Any non-cash
Yeah.
item that has increased the profit or loss statement, we reduce it, we deduct it when we are adjusting for it. So this is it from our format here. Yeah, yes. We are going to see for me. So okay, this is this one. Okay, now if you see what they've done here, if you see what they've done here, you see that the first thing is profit before what? Tax.
Profit before tax. Mm-hmm.
You see profit before tax, then you see adjustment for. Now you see depreciation and amortization, interest charges, income, gains on disposal, losses on disposal. Now all these
So,
are okay.
These are going to be all under operating this thing now.
Activities, yes. They are going to be under operating activities because basically the operating activity represents operation for the period. Because my profit is a function of my operation.
Yeah.
So if my profit is a function of my operation, so to get the cash flow for operating activity, it has to be the cash flows I have used in preparing the profit or loss statement.
Yeah.
So it means that apart from the fact that there are some non-cash items that has been recognized in preparation of the profit or loss statement, there are still some items that are cash in nature. So we want to take away the effect of the non-cash and leave those guys that are what cash. Then we can say we have realized or we have ascertained our cash flow from operating activities.
Oh, you need this one.
So do you get that now?
Yeah, I do. I did.
Then after the adjustment for non-cash items, the next thing we need is what? Changes in the working capital structure.
Changes in the working capital
Working
structure.
capital structure. Changes in working capital structure. Then these changes in working capital structure can either be increase, all those changes that increases or reduces. Now, what's the working capital? Working capital are the is a capital that is used to run the day-to-day operation of the business. And working capital simply means working capital is equal to what current assets minus what current liability. Current assets minus current liability. So the changes in the working capital structure. So what are those changes in my current assets from last year to this year? What are those changes in my current liability from last year to this year? Here is the simple rule. Any increase in assets, is an outflow.
Yeah.
Then any decrease, yes, any decrease in assets
is an inflow.
Now, why? Yeah. Very simple. This is 2019. This is 2020. Let's say we have inventory. So inventory in 2019 was 300. Inventory in 2020 is 400. So what has happened? Inventory has increased
more
by how much?
Inventory. 100.
That's increased by 100, I believe.
Yeah.
So the meaning is that what I have bought more
inventory.
And in the process of buying inventory, what has happened to the cash? Cash has what? Gone out. So don't forget, we are looking at the cash effects.
Yeah.
We are looking at the cash effect. So the cash effect is that in the process of buying that inventory, cash has what? Gone out. So if I have receivables, and last year receivables was 500, this year receivable is 300. There is a change in what? 200.
Yeah, 200.
Now this guy I said is an outflow. Don't forget, changes in assets is an outflow. So increase in assets is an outflow. All right. Okay. So you see that receivable has reduced, right? So what has happened? Yeah. Last year receivable is 500. This year receivable is 300.
300.
It means that what?
Receivables it means that you have collected more money from people that was owing you.
Exactly. Our customers are paid. And if our customers are
Yeah.
paid, money is coming in. So a decrease, that's why I use there, a decrease in assets. Don't forget, change in working capital structure simply means current assets and what? Current what?
Current liability.
Liability. So we are saying a decrease in assets. A decrease in assets will result to
Yeah.
an what? Inflow. An
Will result to
increase.
what?
Inflow.
Okay, yes.
And
Decrease in
increase,
assets
yes, decrease.
and
And
inflow.
increase in assets will result to an what? Outflow.
Outflow.
Yes, so let's go to liability.
Mm-hmm.
Increase in liability. So increase in liability. So here's the gist. Asset is the opposite of liability. Liability is the opposite of asset. So increase in asset is an outflow. Increase in liability will be an what? Inflow. Get it?
Yes, I get it.
Then why decrease in liability will be an what? Outflow. Then at the end of the day, I'm going to have my interest paid. My interest paid, definitely that's an outflow. And I'm going to have my what? Tax paid. That's also an what?
Outflow.
Outflow. Then at the end of the day, I have net cash flows
Yeah.
generated or used in what?
Yeah.
Operating activities. Then this will give me either, depends on whatever the result is, inflow or what outflow. So that is cash flow from what? Operating what? Activities. So cash flow from operating activities simply means that we are preparing or we are determining our operating activity, our cash flow using the what profit or loss statement, because the profit or loss statement shows the operation for a period. So any question now? This is according to the indirect method. So basically, what we are just going to deal with tonight is the indirect method.
This just for
Operating activity, yeah.
operating activities. Yeah.
Operating activity.
So we are just for
Then,
non-cash items, the
before you,
depreciation, the amortization.
okay, so let me just give you a simple rule. After your profit before tax, the
Yeah.
next thing you should do is your what? Add finance costs.
Okay.
Then less gain. Let me create another. Then less interest or dividend. Now, the reason is because, so add finance costs, less dividend. So look at it, finance cost, dividend received, they are finance costs usually represent all the interest expenses.
Okay.
If you remember here, we have interest paid, right?
Yeah.
Now, this interest paid on most occasions, this interest paid will always be this your finance cost.
Okay.
Let's assume that in your profit or loss statement, your finance cost was 500. You know that you would have deducted your finance cost, Abi.
Inside your interest.
You would have deducted your finance cost from your profit before interest and tax.
Okay.
You know,
Yeah.
this is your profit
Yeah.
before interest and tax. Let's say this 200. I'm sorry, 2000. Then this will give you profit before tax. So profit before tax is going to be what? Whatever you have here, right?
Yeah.
This one, it's coming.
Don't forget to watch the
2000 minus 500 is what? 15, Abi. Then let's say you have your tax to be 200. Then this will give you profit after tax to be what? 13. So look at what I'm saying here. This is your profit before interest and tax, right? Are you there?
Sorry. Yes. I was
Now,
talking. I didn't know I muted myself.
all right. This is your profit before interest and tax.
Yes.
This is your finance cost. Now,
Mhm.
this your finance cost represents all interest expenses.
Mhm.
So your finance cost represents all interest expenses. It means that all interest expenses is already built inside the finance cost. All interest expenses is built into your finance cost. So because all interest expenses is built into your finance cost, now generally interest expenses,
Yeah.
except interest has been paid, except the interest has been paid, is a
If the
non-cash
question said,
item.
the interest has been paid.
Hold on. I'm just giving you a simple rule. Except the interest has been paid is a non-cash item. Now, this is what I mean. On your profit or loss statement, that's your finance cost. Represents your interest expenses. Is that one clear? Hello?
Yeah. Sorry. I don't know
I said
what happened.
your profit or loss on your profit or loss statement, that's your finance cost, represents your interest expenses.
Okay.
Now, the first thing to always do is after your profit before tax, the first thing to always do is add back the finance cost. Then less your interest or your dividend received. Now, if in the course of the question, you now come across maybe under your liability section, you come across interest payable, maybe interest payable accrued interest. So the implication is that that's your finance cost that represents your interest expenses. Those expenses have not been paid. So it means that we are still owing some expenses. Then you now make some adjustments. So the adjustments you are now going to make is, so this is what you are going to do for interest payable now. Interest payable. So this is the adjustment how it's going to be. So your balance brought forward. Balance brought forward. Then you add your finance costs. You add your finance costs. Then after adding your finance costs, then what you have here will be balance carried what down. So at the end of the day, after having your, you know that after you add your finance cost, you are going to have a balance here, right? So this balance you have here after adding your finance cost, it is the difference between this guy and this guy will be your what? Interest what? Paid. You get? So I said in your profit or loss statement, your finance costs would always represent your interest paid, except in the question you are given an accrued interest. So if in the question you are given an accrued interest, it means that your interest, you are still owing an amount of interest. So we want to know how much exactly is the interest that has been paid for the period. Okay, so I can't hear you clearly.
Can you hear me?
Yes, I can.
Let me just clarify. When you open your statement of cash flow with profit before tax, ideally, profit before tax, you're supposed to add back the finance charge and then less your interest and dividend. But you are saying that your finance charge is made up of interest that has already been paid.
No. Your finance cost is it comprises of all interest expenses.
Okay, comprised of all interest expenses.
All the interest expenses, yes. So what I'm now saying is that after you have added back your finance costs to your profit before tax, if there is no other additional information, then that finance cost represents this interest paid here.
Okay.
Finance cost represents this interest paid if there is no other additional information. If there is other additional information, maybe on your statement of financial position, there's a place on the statement of financial position where you have accrued interest. Accrued interest.
Accrued interest, yeah.
Yes, they are simply trying to tell you that that's your finance costs. You are still owing a portion of that your finance costs.
Okay.
You know, normal, your finance costs are interest expense. Let's say, for example, loan. If I obtain a loan of 10%, a loan of 5,000, and the interest rate is 10%. So the interest expense on the loan is 500, right?
Yeah.
So now, generally, this 500 will be my interest expenses for the period.
Yes.
Now, is this 500 that will be my finance cost? So it is this 500 I will deduct from my profit before interest and tax. Before I get my profit before tax. Do you understand?
Are you deducting it? Okay,
before I get my profit before tax.
Okay. Yeah.
You know, the 500 is an interest expenses as a result of the loan I have obtained. I have obtained a loan of 5,000, and the interest rate on the loan is 10%.
10%, so 10% which is 500
10% exactly, which is 500 naira. So ideally, the 500 naira is an interest expense, which is your finance cost, right?
Yes.
So you know, in your profit or loss statement, you have your finance cost. That place you have your finance cost. You have to deduct your finance cost from the profit before interest tax, right?
Yeah.
Now, after deducting your finance cost from the profit, before interest and tax, it is ideal that you recognize that amount of interest as a current liability in the statement of financial position. Why? Because it's two ways. I can be told that 500 naira interest has not been paid for that year.
Yeah.
Are you with me?
Yes.
Now, if that 500 naira interest has not been paid for that particular accounting year. So the meaning is that I will treat that 500 naira as a finance cost and I will treat it as a current liability.
If it has not been paid.
Exactly, if it is still owing.
Okay.
Now, I am now saying that in the event that the 500 naira has been paid, I will only treat it as a finance cost. I won't treat it as a current liability because it has been paid.
That's been paid. Yeah.
It will not appear in my statement of financial position as a current liability.
So it's only going to appear in that interest alone. You less is from that interest alone.
Correct. So now look at this simple scenario now. Let's come back to cash flow statement. So I'm saying in the event where that finance cost does not appear in your statement of financial position as a liability, it means that that finance cost has been paid for the period.
Yeah.
So this finance cost that is here, that you have added back to your profit before tax, is what you are now going to deduct as interest paid.
Okay.
In the event that it is not appearing as a current
liability.
But if it is appearing as a current liability in your statement of financial position, then this is how you are going to adjust it. This is the adjustment. So you adjust it this way to get the portion of the finance cost that has been paid as what? Interest. So here's the portion. This highlighted part is the portion. So this portion represents interest that has been what? Paid.
Yeah.
Do you understand?
Yeah, I get you.
So that is how to treat the interest paid. For the tax paid. Now, so how do we treat our tax paid? Very simple. For opening balance. Now, opening balance can either be current year tax and what? Deferred tax. Current year tax and deferred tax. Then you what? Add income tax expense. No, income tax expense.
Okay.
That's the one in your profit or loss statement. You add it. So after adding, then you have your balance carried down. So this is your balance carried down. So the difference between your balance carried down to can be current year tax and what's deferred tax. Depends on the nature of the question. So the difference between the addition of this guy and you deduct this guy will be your what? Tax what? Paid. So tax paid because you have paid it. So that's how you are going to determine your tax paid. That's simple. You get that?
I got you, but look at it. You said opening balance, and your tax adjustments is opening balance. That's current year tax or deferred tax. Plus income tax expense.
Yes, the income tax expense. That is in your profit, in your statement of profit or loss. You know you have profit before tax.
So then you have the tax.
Exactly. So this tax portion is your income tax expense.
Yeah.
So you add it to the opening balance to give you this guy. Then this guy minus this guy will give you your closing balance. So the difference between your opening balance and your income tax expense and your closing balance is your tax paid.
Well, okay, you less your tax paid. Hold on. When you add your opening balance and income tax, you less your tax paid. Tax paid is where are you getting tax paid from?
So the tax paid is the difference between your opening balance. This is your opening balance, Abi.
Yeah.
Now this is your opening balance, right?
Yes.
Then you had income tax expenses, right?
From POL.
Exactly. So it will give you, let me say it will give you YY.
Mm.
So the difference between YY and these two guys will give you
Okay.
tax pay.
Balance. So
Yes, the difference
so
between that YY and your balance carried down will give you your tax
your
pay.
opening balance can be current tax year, then current you know they always give you like 2 years now. So the opening
That's what
balance is
I'm
going to
saying.
be the first year, and then this other one carried down is the
The
second
second
year.
year, exactly.
Okay,
So
that makes sense.
that's how to determine your tax bill.
Mm.
So, and at the end of the day, you have your net cash flow from generated or used in operating activity. So then,
All this tax adjustment, interest adjustment, it happens in
yeah,
operating activities alone, right?
yeah, yes.
Okay. So if you have your question, you just do your normal format of profit before
Exactly.
tax, then you do operating activities, adjust for none. Okay, no, before that, operating activities under you have your PBT, then you add finance charge, then
Exactly.
you less interest and dividend, and then you go ahead to do your adjust for non-cash items. When you finish adjusting non-cash items, you now do changes in working right, changes in
Yes,
working capital.
changes in working capital structure. Then
Mm.
after changes in working capital structure, you less your interest paid and you less your tax paid. Then you have your net cash flow generated or used in operating activity.
So you less your interest paid, then you
Yeah.
what do you add again?
You less your tax paid.
Okay, you also less tax paid.
Yes.
Tax paid. I need to write. You have to adjust first. You adjust. Do you interest paid? Yeah, you adjust interest. Do you adjust interest paid here?
You will
If
adjust
there is
interest paid if there is
if there is
a liability
there's a
portion.
liability unpaid.
Exactly.
Yeah, adjust if there's a current or liability. Okay, or accrued. Are they going to write accrued or current? Waiting, if you have a non-current
Once you
liability
just
or accrued,
once you just see interest expense, then once you just see interest in your statement of financial position,
mm,
it represents a liability.
okay, 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 that's okay.
Okay, let's look at um, so for investing activity and financial activity, majorly those ones don't have problem. The major issue in your cash flow statement is your operating activity.
I believe so
So
too, but
let's look at that question, and why we solve that question. We're going to So let me do this. Okay, let me make this side. I don't know if it's naira. Let me see, is it naira? Okay, it's naira. Okay, it's in million. It's in million. It's in million. It's in million. So okay. Let me just do this. Carving. Okay. So just use this place as my workings. I'll use this place as my workings. Okay. I'll use it as my workings. Okay. So, are you with the question, right?
Which year is this?
Last diet.
Last diet. Ah, no,
Yes.
I'm not with the question. I know I'm outside. I'm not even at home now.
Okay.
That I told you now that I'm outside. So
Okay, it's fine. I'm going to project it.
yeah, you were projecting it like sharing. Say you're sharing your screen. I can see from there. I can see like this.
All right, no problem. Okay. Let's. Okay. So
Okay,
I should use what?
use better color. Which kind of color will they use like this? I know they see you. I'm colorblind.
Okay, this one.
Yeah, it's okay.
Okay, the name of the business is what? Chuku Nigeria Limited.
Puka.
Chukuka, right? Nigeria Limited. Okay. Let me just Chukuka. Chukuka. You know what's wrong with this? Why it's even more color? Sorry. Um,
What's the issue now? What's the issue? What's the
like
hold
I'm trying to write this. I see. The thing is another. Okay, sorry. Okay. Okay. I think this is fine now. So Chukwuka Nigeria Limited. Chukwuka Nigeria Limited. Then I'll have statement of what cash flows for the period ended 30th April 2025. So we start from cash flows from operating activities. So let's start with cash flows from operating activities. So this alien. Okay. So don't forget the first thing is your what? So we're told that the financial statement of Chukwuka Nigeria Limited are drafted below. So you have the statement of profit or loss for the year ended. You have the statement of financial position, and you have your additional information. So, how I love to start. So let's start like this. So this is my own approach that makes it easy for me. So let's start with profits before tax. So profit before tax will give us what? How much is profit before tax? 18,300 and what? 15.
18315, yeah.
Exactly. Make this place to be. Now the next thing is what? Add your what? Finance costs. So if I add my finance cost, I'll be my finance cost here. That's what? 5,220. Now, why am I adding finance cost? I'm adding finance cost because finance cost has been what?
I've been deducted. I've been paid.
Exactly. So no, it has been deducted. It's not that it has been paid.
Deducted.
It does not
deducted doesn't mean
necessarily
it's paid.
that it has been paid. Yeah. So now, if you look at it now, I have interest received, right?
Yes, I've seen
Then
interest received.
all interest expenses, the same thing, less interest
Yeah.
received. Interest received. So interest received. Now, since interest received has been added there, what am I doing?
You subtract
I'm
it.
lessing.
Okay.
So the next thing I'm going to do is now what? Adjustments for what?
Non-cash
items. So let me do this. Equal to this minus, oh, no, sorry.
Is it plus now?
So that will give me 3,550. So I have
550.
added these two together to give me this. So we start our adjustment. Now,
Okay.
all these adjustments for non-cash items. Now, we now start
Yeah.
with your additional information.
Information.
So, this is the first way I always start. There's the first workings I always do. The first working is movements in
Cash
cash,
and cash equivalents.
cash and what?
Cash equivalents.
equivalent. Now, why I like starting with movements in cash and cash equivalent is because that's our final destination. That's where I am going. That's what I'm looking for. So if I have my movements in cash and cash equivalents, I will just go and plug in, like I'll just go and fix in that result. Then I know that that's where I am going. What are those things that forms my cash and cash equivalents? Cash,
Cash.
cash, bank, short term investments, and bank
Overdraft.
draft. Those are the things that forms my cash and cash what
Equivalent.
So let's go. Do I have
Okay.
cash? I have cash, right?
Cash in hand, yeah. Are you
So
going to add
this is
both of them?
yes. Let me bring this here. Let me bring this here.
2025 and 2024.
Sorry, let me bring this here. So this will be 2025 and this will be
2024.
So this will be at the beginning and this will be at the what end. So I have cash, right? So cash in hand. How much is cash in hand at the beginning? 360.
Cash in 360.
Then cash in hand at the end, 930.
930.
So do I have bank? I don't have bank.
No, there's no bank.
Now I have
You have
short-term investments here.
investments.
Let us look at what did the additional information say about short-term investment. They said if you look at additional information 3, can you see?
Yeah.
Let me highlight it. Said the short-term investment is highly marketable with 1 to 3 months maturity profile. So that indicates that it's an
It fits for our
instrument.
short term.
It's an instrument that we are going towards
Easily
realize
get cash from.
between 1 to 3 months. So they are short-term investments. So I'll just come here.
You add it.
Short-term
Investments.
That's going to give me how much?
Short-term investments.
For the
3.8.
beginning, no,
Beginning
2007
is
at the
2.7.
beginning, then at the end 3,800 and what? 10. Now I have bank overdrafts.
Bank overdraft.
Now what would bank overdraft give me? Bank overdrafts. What will it give me? What's my bank overdraft?
You can't see that this thing again.
So I'm just checking something. Okay. My bank overdraft is at the beginning. At the beginning is what? 7,530. The end is 6,000.
40.
Now, because it's a I will deduct. No, it's an overdraft. I will deduct. Let me trying to make it in counting form. So now there's something in the question. If you look at the last additional information, Are you with me?
Yes, I'm with you.
Now, this last additional information says a cash payment of 58 million made in respect of insurance premium for the financial year ended April 30, 2025 was totally omitted from the book.
Yes.
A cash payment of 58 million for the year.
Yeah.
Now, it means that in the year 2025, we did not record it. So,
Okay.
if we had recorded that 58 million, it would have had impact on our cash.
Yes, yes,
It's
yes.
going to reduce our cash, right?
Yes.
It did not record that 58 million. So, because we did not record 58 million, we are going to make adjustments for the insurance premium now. So, I'll call it insurance premium. So, to only affect 2025 because the insurance represents insurance for 2025. Are you with me?
I'm with you.
So how much is that? 58.
58 million.
Exactly. Then at the end of the day, what will be my net? Then this is going to give us so let me say so wait. So let me just make it like this. So this, then for this is this. So at the end of the day, this is what I have at the beginning. This is what I have at the what end.
At the end.
At the end. So let's go and do something now. Let's do something. Let's do something. So I'll come here. You know, this is my cash flow from operating activity, right? So let me say here we have cash flows. Let me make the column big. Cash flows from interesting activities. Then after cash flow from interesting activity, I have cash flows.
Is it not too long? Where they go? We'll get plenty things like that.
If after posting, I will remove every other sheet. Cash flow from financing activities. Then, so after my cash flow from financing activity, so now let's fix in that this thing, and I'll come here. Cash and cash equivalents at the end. I'll come here. Cash and cash equivalents at the beginning. So now that's cash and cash. Let me see where the currency sign is again. This side I will trace it. So our cash and cash equivalent at the end. 1858 Abi. Remember is 1858. So let's post it there. 1858. Let me remove the 1858. No, that's supposed to be negative 1858.
Let's check it. Is it negative we had there?
Yeah, it's negative. Then
Okay, yeah. Just copy from this. Just copy it now. Why are you stressing yourself?
No, I use the function. If I copy it to do dash,
Okay.
so this is 4380. 4380. This is 4380. So at the end of the day, if you look at it, 1858, 4380. Now let's then plus this will give me 8760. So this will give me decrease in what cash.
How is this thing even correct? 8. Are you looking at this calculation? How is it 8?
This plus okay. This, okay, so this is our destination. So this is where we are arriving at. So it means that at the end of the day, when I sum up, I must get this value.
Yeah.
So let's go. Now let's start with our working. So let's move to working. So let's take it now.
Additional information.
The financial assets included in the trade investment with a carrying amount of 15 was sold for 180. So we look at that place.
It's noisy, Abby. I'm coming. I can sleep. Oh God. Oh God. How about now?
Okay, I'll probably.
It's better now, right?
Yeah, it's better. It's better.
Yeah, it's better.
Better now. Better now.
Okay.
All right.
Okay.
Now, so the additional information 1 says a financial asset included in the trade investment with a carrying amount of 15 was sold for 1,855 million during the year, while a replacement was also required. So it means first, trade investment. We have trade investment here, right? So let's make adjustments for trade investment. Trade investments. Trade. What's trade investments? So let's look at it. Don't forget, we always start with opening balance.
Yeah.
So let's start with opening balance. Balance brought forward. Now, what's the balance brought forward for last year? That's how much? 2,860. Now, let me bring balance carried what? Down. Balance carried down is what? 1,835. So look at something. They said this trade investment, a financial asset included in the trade investment with a carrying amount of 15 was sold for what? 18. So as at the date of disposal, the carrying amount of that financial asset was included in the financial statement at 15. So the carrying amount of that financial asset is 15. Don't forget that when you want to determine the sales process, gains or loss on disposal of an asset, You compare the carrying amount of that asset, then the sales proceeds from that asset. So the carrying amount of that trade investment as at when we dispose it was how much? 1.5.
One
So
five.
I will perform a disposal. And because I'm disposing it, is it increasing or reducing?
In the asset is reducing now.
Exactly. So if the asset is reducing because I'm disposing it, then let me come beside it, disposal
Mm.
account. Disposal account. Disposal account. So the carrying amount now, trade investment, right?
Yeah,
How much is the carrying amount of the trade investment that was disposed?
1.5.
1.5. So now on our disposal, so we have the sales proceed. What's the sales proceed?
1885.
1885. So when your carrying amount, let me just make this one trade investment, then let me put carrying amount in front. So the carrying amount is 1.5. The sales proceed is 1885. Is it a gain or a loss on disposal?
Again,
A gain. So gain on
disposal.
disposal of what? Trade investment. So the difference is going to be what?
385.
385. Come,
Yeah.
let me do all this format. So make it bold so that all this thing will be easy for me to do. Okay. Now, sales proceed is an
Mm.
what? An investing activity.
Okay.
Sales proceed is an what? Investing activity. Do you get now?
Mm.
Sales proceed is an investing activity. So that means on that cash flow statement, I'm going to recognize this sales proceed as an what? Investing
Investment activity.
activity. So let's go and post. Okay, let me not post the financial as the trade investments yet. I don't know if there's any information on trade investment again. I think that is all about trade investment. So look at your trade investment now. 28 minus 1.5 will give us what?
2860 minus 1.5 is going to give you 1360.
60 minus 1.5.
1360.
So it means
Yeah.
that, so look at it. At the beginning, my trade investment was 2,860.
Mm-hmm.
And I dispose it for 1.5, and I'm left with 1,000 what? 360,
360.
right?
Mm-hmm. Yeah.
If I deduct 1.5 from it, I'm left with 1,360.
Yeah.
Then at the end, my trade investment is 1,835.
Mm.
What does it mean? It means that during the period, if you look at it, my balance at the beginning, my balance at the end is more than the balance I have after I've deducted disposal, right?
Mm-hmm.
So the implication is that during the period, I acquired additional what? Trade investment. So cash was paid. So cash paid will be the difference between this and this. Okay, this is not correct. This will be 860 minus 15, right?
Mm-hmm.
Then plus 185. 3105. Are you sure? So it's 2860 minus 1. Okay, so it's supposed to be negative. This is supposed to be minus. That's 475. Do you get it?
Mm.
Do you get now?
Let me see the click on that. This thing. Let me see the formula again. Mm-hmm. Yeah, you all minus everything. Yes, this is how it's supposed to be.
Exactly.
Mm-hmm.
Exactly. So this will be cash paid.
Mm-hmm.
This will be cash paid for trade investments. For trade investments. Cash paid for trade investment. So let me come to my listing. So how much is cash paid for trade investment? 475 under investing what?
Activity.
So cash paid for trade investment. So cash paid for trade investments will be, let me see, under here. So that will be 475. That's an outflow, 475, right?
Yeah.
Then don't forget, we said a sales proceed. Sales proceed. Sales proceed on trade investment. How much is sales proceed on trade investment?
1885.
1,885. That's an inflow. So sales proceed on trade investment. One what? 885. Then lastly, so you can see I'm taking one information and I'm doing the adjustment and I'm posting it.
Mm-hmm.
So you see, for trade investment now, I have done the disposal and I've done the disposal account. I have realized said for a non-current asset is an investing activity. Then any sales proceed realized from the disposal of a non-current asset is an investing activity.
Yeah.
Then finally, any gain or loss on disposal from any non-current asset will be used in adjustment for your what? Non-cash item. So you can see one information, we have had 3 different treatments.
Mm.
Things on disposal of what? Trade investments.
Investment.
It's on disposal of trade investment because it's a gain, it's going to be what?
Added.
An out. No, it's a gain.
It's a
gain
gain.
added.
Okay.
It's an income. It has added. It has been added to your profit or loss statement.
Okay, so you have to take it out.
Exactly. So we have to take it off. So we are done with treatment of trade investment. Let me go and tick it. Okay, I've ticked it. We have done it. Let me tick this one as well to indicate that we have what done it. Now the next one. So the idea is that take all your additional information one after the other, be treating them. After you are done treating your additional information, now always note that all the items in your statement of financial position must all be exhausted. They must all be exhausted. You are using everything. So after treating all the information or your additional information one after the other, then you go back to your statement of financial position. Any item you are yet to treat, then make the adjustments for it and treat it. Then check your statement of profit or loss as well. Any item you are yet to treat, make the additional information and treat it. So and it's cool like that.
Okay.
So the next one, there was an issue of 3,750,000 ordinary shares during the year at a premium of 32 kobo per share. Now let's check. anytime there's an increase in shares in 1 year to the other year, it simply means a new share has been issued during the year.
Mm-hmm.
So, ordinary share
Hey,
capital,
Bolaji,
yes.
I need to start going from where I am now. Eh? I need to start going.
So we can't. So
Bolaji, did you hear me? So,
yeah, I'm like I'm saying, so we'll be able to finish this near.
what time are you sleeping?
Uh, because of you, I'm still.
But can we do early in the morning? Like, can we
Early,
conclude this early in the morning? Is it
early in
possible
the,
for you? Is it
what time?
possible for you? I mean, I'll be awake from 4:30, from 5. Is it possible for you? We can conclude this
Okay,
particular one. Is it
let me see.
possible for you?
Let me see. Let me see.
But if we cannot, if it's not possible, we can continue tomorrow evening. But I don't know if you are going to come back earlier than today. Because
It's
where I am now, it's still far from where I'm going to. Eh?
oh,
Yeah, that's why. I
okay.
beg. Let's
Problem.
just please keep this my screen very well. Though.
Problem.
So anyone that is okay for you to work, I'll be awake by 5, but I'm not going to disturb you. See if you're awake, fine. If it's okay, fine. But if it's not, we can do it in the evening.
No problem. No problem.
Okay. Thank you very much. I appreciate it. No worry, we'll go.